Hey everyone, welcome back to Financially Free. If you like me talking about stocks that I normally don't talk about, please let me know down in the comments below because that really helps me gear my content more towards what you want to learn about. And if you could also like and subscribe to the channel, it really helps me out a lot. Now, let's go ahead and get into some stocks that have reached their 52-week highs and 52-week lows and determine whether I think they are a buy or not. All right. So for some of you very beginner traders, basically what a 52-week high means is that it's the highest a stock has reached in price or value in a 52-week trading period. A 52-week low means it's the lowest that a stock has traded at within 52 weeks. Now, a lot of people ask me, should I buy if a stock is at a 52-week low? And personally, I don't think that's necessarily meaning that it's a good deal, okay? A lot of people think, oh, well, it must be a steal deal. It must be the perfect time to buy if the stock is trading at the lowest it's been all year. Surely it has a ton of room to run and grow. Well, that definitely could be true. However, it could also be that the stock has very bad financials. It's under the wrong leadership. The business hasn't been performing quarter after quarter. Perhaps they're facing a lawsuit or even bankruptcy. Now, on the flip side of things, when Meta hit a 52-week high, a lot of people thought that surely Meta cannot go any higher. It must be a good time to sell. Now, if you were to have sold Meta last year when it was at its 52-week high, I mean, you would have lost out on a ton of profit, a ton. A lot of people were thinking, oh, it's at 175, it won't go any higher. Then, oh, it's at 200, it won't go any higher. It's at 250. Now the stock is worth around $330 today as of December 11th, 2023. Okay, so sometimes a company is so undervalued and people have either lost belief in it, maybe they had some things going on, whatever it may be, but that's why you have to understand how to evaluate a stock, look at how to judge whether a stock is a buy or not, and you must understand how the company works and what things affect it in both the positive and the negative. Okay. Now, again, understanding the company is extremely important, right? Because if you don't understand the company and the business model, you are very likely to fail. Now, getting into a business model, to be honest, that I really don't understand, and I think a lot of people probably don't, is a company called Pfizer. So, Pfizer is our first stock that we're going to jump into about whether it is a buy or not. This is a major, brand name stock, but let's go ahead and dive into why Pfizer is not a buy. All right, everyone. So I'm sure you remember in the beginning of the video, we talked about stocks that have reached a 52-week low and kind of picking our own brains and asking ourselves if that means the stock is now a buy or not. Now, again, oftentimes stocks that have reached a 52-week low can have a lot of room to grow and get better. But on the converse side of that, it means that it could also be at that low price because their business is failing. Now, I hope my honesty and transparency makes this a great teaching point for you. When it comes to Pfizer, I do not understand their business model whatsoever. I don't understand how, if a drug gets approved, whether that'll make Pfizer's stock price jump or go down further. I don't understand their business model really at an infinite level. I don't understand how the regulatory environment affects the stock price in the various drug companies. And I really don't understand how any of these different news articles could affect their stock price or the business at the core of themselves. Okay. Now, I've made money off investing in these types of stocks, but I would chalk it up pretty much to just being, lucky. And with Pfizer being so low, sure, you could make money and it could run up, but why would you want to place your hard earned money into something that you don't understand? Now, if you're different than me and you're very educated with Pfizer and you understand in and out how the health business model works and how their business model operates, by all means, you can make the decision for yourselves whether you think it's a good buy or not. But again, I would never buy something that I do not understand. We were talking about Meta earlier. Now, with Meta, I use their platform. I understand how it works. I understand that they make revenue off of ads. I understand that Meta is kind of a monopoly, that they buy out other competitors, and they own various different companies like Snapchat and so on. I know that Meta is involved with AI research as well as virtual reality headsets and different technologies, right? So if an article came out about Meta that all of a sudden they couldn't run ads on their social media platform for some legal reasons, and that got approved through the court systems, then I know that Meta's stock price would actually, absolutely tank. I could avoid the disaster by understanding what makes Meta tick. With Pfizer, I don't understand how it ticks. It's very complex, and to be honest, I don't think a lot of people do. But if again, if you're one of those people that do understand how Pfizer works, go ahead and make an educated decision for yourselves of whether it's a buy or not. But me personally, even though Pfizer's at a 52-week low, I plan on staying away from this for a long time. All right, everyone. So let's go ahead and get into the next stock that has hit its 52-week low, and that is Walgreens. So Walgreens has a couple problems within its business model, and I think the key factor is going to be finding out if the newer management team is capable of implementing new things into their business model that could help make Walgreens more successful. Walgreens needs a little bit of a restructure, I guess you could say. Now, just so it's clear, Walgreens is no longer at its 52-week low price. It has gone up about $3 to $4 per share in the last 5 trading days or so. However, Walgreens is still at a very low and good price to buy at, in my opinion, at its current price, which is around $23.50 per share. Now, another reason why Walgreens, I believe, fell to its 52-week low is because there was speculation and rumor that they might be cutting down their dividend per share. Now, as a long term investor, one of the main reasons I invest in Walgreens is because their dividend yield is phenomenal, to say the least. Okay. You get about a 9.14% return per share, which is about 48 cents quarterly, which is about $1.92 per year per share that you own of Walgreens. So you could, see how that could add up pretty quickly. Okay. So you can receive a lot of passive income and either choose to reinvest that into Walgreens or another play, whatever you'd like to do. But you basically just get, a really nice return just for owning the stock. Another plus side of Walgreens is that, back in 2019, this stock traded around $60 a share. So if the newer management team can really get things together and start making Walgreens more profitable again and more appealing to the masses to use them as their pharmacy, then I think Walgreens has a lot of room to grow. And not only will you be collecting those dividends quarterly, you'll also be able to make a lot of money from the growth perspective as well. You can probably even double up your shares or maybe more. Um, so there's a lot of money to be made on Walgreens, whether it be passively or actively by trading it. I think Walgreens is an awesome opportunity. Now, I always like to play devil's advocate a bit. So, with the rumor going on that the dividend yield might be cut, I just want to be clear that that is all speculation. There's nothing factually to base this claim on yet. Um, but hypothetically, if Walgreens cut their dividend and the management team did not improve the business's profitability, then this could be a very risky play, okay? Because a lot of investors will jump ship when they know that they're not making what they would like to on their dividends anymore. And on top of that, the share price is compromised as a business itself, okay? So on one side, I think this is a phenomenal stock, but you could also argue that it might be in trouble. But I have faith in Walgreens. I think the management team will pull it together. I'm really looking forward to enjoying all my passive income I'm going to be receiving from this stock. And I'm also looking forward to making money on its growth and its way up as they improve their business. All right. So our next stock that is at a 52-week low is Alibaba. So, for those of you who don't know, Alibaba is a Chinese stock, which I'm sure you know can be quite risky to put it lightly. Okay, typically I don't invest in Chinese stocks, as you know there's been evidence that they have falsely reported numbers in the past, or manipulated their different stocks that they trade. Now, if Alibaba was an American stock, this would probably be in the top three, on the most, you know, most profitable stocks to buy right now in December 2023. However, Alibaba isn't an American stock, and it's not as clear cut owning a Chinese stock as it is clear cut owning an American stock. Um, you know, um, if we look in the same sector, we have stocks like Amazon. Now, when you get information or news about Amazon, it's accurate and legitimate. And when they post their numbers up for everyone to see, and you look at their financials and their earning reports, you can, feel safe at night knowing that that information is correct. Now, me personally, I do own Alibaba, but it is a very small portion of my portfolio to mitigate risk. I would never take a large position in any Chinese stock in my personal portfolio. Um, for those reasons I just went over. Now, I do believe you can make some really good money on this stock. I will be investing into it long term. I think it's at a very good value price right now, where it's trading at. Now, if you don't understand what the VIE structure is, then I would absolutely not invest in Alibaba. Okay. The VIE is, it means a variable interest entity. Okay. So Alibaba is a variable interest entity, which basically refers to a legal business structure in which an investor has a controlling interest despite not having a majority of voting rights. So investors in VIEs do not participate in residual gains or losses. So that's just the basic overall definition. But if you don't understand how that affects being a shareholder and how Alibaba might trade, then I would highly suggest just staying away from this stock. All right, everybody. So the last company on the list is Fisker. Fisker, Frisker. I don't know. Fisker sounds like a cat food or something. But for those of you who don't know, okay, Fisker is an electric vehicle company. Okay. And, you know, if you look at Tesla right now, with interest rates being so dang high, they are struggling. They are struggling to make a profit. And, we saw that on their last earnings. Okay. And even with the excitement of the Cybertruck coming out and all these different things, it's really hard for Tesla to meet the profitability range because you can't mark your cars up too high and then nobody buy them and be sitting on all that inventory. But if you mark them too low, then you're cutting out all your profit margins, and you're just working to work. You're not making any bang for your buck. So I think the automotive sector of business right now, all of them are really struggling. So again, if Tesla is struggling right now, which is the most dominant EV car maker in the world, I don't think Fisker has a chance. I mean, really, how are they going to hold up? Unlike Lucid, which is another company that makes EV cars, Lucid has a strong backer and has someone to help them, pump money into their account when they need to continue developing their product or services. But with Fisker, they don't have a strong financial backer. They don't have anyone to bail them out. So this is kind of do or die for them. And unfortunately, they're still in the beginning stages. So for them, they don't really have time to not be profitable. But 2024 and probably 2025 aren't going to be helping them out any more than 2023 did. I personally think interest rates are still going to be very, very high. And it might already be too late for Fisker because they're already getting towards bankruptcy prices. They don't have a financial backer. I mean, what's going to bail them out? It's just, in my opinion, it's a matter of time before Fisker faces bankruptcy. It's unfortunate. I mean, if you look at the pictures and their vehicles online, I mean, in that picture there, that's the known as Karma. That's the name of the car. I mean, it's beautiful, beautiful on the outside, beautiful on the inside. It's a beautiful car, but unfortunately, like I said, they're really at the worst. Um, they had the worst timing in the market. Let's put it that way. They just got hit with a bad luck stick, and so yeah, I'm sure play devil's advocate a little bit. I'm sure you can make money off this play, maybe swing trading it, catching the highs and lows if you're a day trader. But honestly, I wouldn't touch Fisker at all. I would stay far, far away. All right, so that wraps it up for the video, guys. Thank you so much. If you like this content, please like and subscribe and comment down below. Thank you. Thank you again so much for watching. I really appreciate each and every one of you. Thank you again for being a part of this video today. If you could please like, comment, or subscribe to the channel, it would mean the world to me. Thank you so much, and I hope today I help one of you become more financially free.